Hello and welcome. Today, let's break down a simple but important question. What if crude oil stays between $90 and $110? Not for a few days, but for months. And not just as a spike, but as a sustained level. Most people look at oil and think fuel prices petrol, diesel, maybe transportation costs. But oil is not just a commodity, it is a macro variable that quietly influences growth, inflation, currency, policy, and markets. It sits at the center of the economic system. So the real question is not will oil go up? The real question is how much does it slow down India if it stays high? Let's start with what changed. Most economic projections, whether from governments, analysts, or markets, were built on crude oil being around $65 to $70. That was the base assumption. That is what businesses planned for. That is what policymakers expected. That is what markets were comfortable with. Now imagine this. Oil averages around $90 for the year and even spikes to 110 for a few months. This is not just a higher number, this is a different environment. That is a 30 to 50% deviation from what the system was expecting. And in macroeconomics, it is not the level, it is the deviation that creates stress. Because systems adjust slowly but shocks arrive suddenly. Now, why does this matter more for India? Because India imports roughly 85% of its crude oil. That means India is heavily dependent on global energy prices, which also means this is not an internal imbalance. This is an external shock hitting the system directly. India does not control it, India has to absorb it. Every time oil rises, India has to spend more dollars to import the same amount of energy. Not more energy, just the same energy at a higher price. And that creates a chain reaction that begins with the import bill. There is a simple rule of thumb that economists use. Every $10 increase in crude oil adds about 12 to 15 billion dollars to India's annual import bill. So if oil moves from 70 to 90, that is a $20 increase, which means India is now dealing with roughly $25 billion of additional import cost. Think about that. $25 billion is not just a number. It is money that could have gone into infrastructure, into consumption, into investment. Instead, it is going out of the country. This is not theoretical. This is an actual transfer of wealth. And when more dollars are needed, the rupee naturally comes under pressure because the demand for dollars increases, but the supply of dollars does not increase at the same pace. Exports do not suddenly jump overnight. Capital flows are not guaranteed. So what happens? The currency adjusts, the rupee weakens. A 3 to 6% depreciation becomes a very reasonable outcome in this kind of scenario. And this is where second order effects begin because currency weakness feeds into inflation. Now let's understand how inflation actually spreads. Because oil does not stay in oil, it flows through the system. It starts with transport. Transport affects logistics. Logistics affects the cost of moving goods. That affects manufacturing. And eventually it reaches food. So even if you do not directly consume fuel, you still end up paying for it indirectly. Every product you buy carries an embedded energy cost. That is how inflation spreads quietly across the economy. In this scenario, we are looking at inflation rising by roughly 0.5 to 1.2%. Now, that number may sound small, but inflation is not just about magnitude, it is about direction and persistence. And more importantly, it is about what it forces policymakers to do. And this is where things become critical because the biggest impact of oil is not just inflation itself, it is what inflation does to policy flexibility. Earlier, the expectation was that the RBI could support growth, maybe cut rates, maybe maintain easy liquidity, maybe encourage credit expansion. But now that option starts disappearing because when inflation rises, the central bank cannot afford to be accommodative. It has to protect stability, it has to anchor inflation expectations. So instead of supporting growth, it shifts towards defending the system from support to defense. And that is a very important transition. Now let's come to growth. This is where things become subtle because growth does not collapse. There is no dramatic breakdown. Instead, growth slows down quietly. Real GDP, which reflects actual economic activity, can decline by about 0.6 to 0.9%. Consumption slows slightly, investment becomes more cautious, margins get squeezed. But here is the interesting part. Nominal GDP, which includes inflation, may not fall as much. In fact, it can look almost stable because higher prices compensate for lower real activity. So, on the surface, the economy looks fine, but underneath, the quality of growth deteriorates. This is a classic macro illusion. So, what is the real issue here? It is not oil prices alone, it is the constraint oil creates on the entire system. The RBI cannot cut rates freely, the government cannot expand spending aggressively, the currency cannot weaken without consequences. Every lever becomes constrained, and when a system loses flexibility, it cannot accelerate. It can only sustain or slow down. Now, let's connect this to markets because this is where most people are focused. Markets do not react directly to GDP numbers, they react to liquidity, earnings, and valuations. And all three get impacted in this scenario. Liquidity tightens because interest rates cannot fall, earnings come under pressure because costs rise, valuations compress because higher rates reduce risk appetite. But here is the key point: markets do not always crash in such environments. They adjust, they reprice, they move into a slower trajectory. Earlier, you might have expected around 10% annual returns from the market. That was based on stable growth, controlled inflation, and supportive policy. Now, with these constraints in place, that expectation needs to be recalibrated. Returns may move closer to 6 to 7% annually. The direction of the market may not change, but the speed changes. And over a 3-year period, this translates into roughly 12 to 15% return compression. Not a loss, but a meaningful reduction in expected gains. This is not destruction of wealth, it is a delay in wealth creation. And that brings us to the key takeaway. In macro shocks like this, markets do not always punish you with sharp declines. Sometimes they punish you with time, with slower compounding, with missed expectations. India does not break under oil shocks. It has resilience, it has buffers, it has structural strength, but it cannot accelerate under constraint. And markets reflect that reality quietly, gradually, and persistently. Thank you for watching. If you found this useful, take a moment to reflect on what this means for growth, for markets, and for your own expectations. See you in the next one.